Good morning from our world headquarters in New York. I'm Menace Cranny.
And from our studios in London, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
A sell-off in global bonds gathers pace. Treasuries bulldoze their way through the world markets to the greatest extent since the pandemic hit in 2020. Testing the BOJ. The yen retreats as officials refuse to say whether they intervened to bring stability in the FX market. And DC drama adding to the turmoil. Kevin McCarthy becomes the first ever U.S. House Speaker to be removed from his post, increasing the odds of a U.S. government shutdown.
I believe I can continue to fight, maybe in a different manner. I will not run for Speaker again. I'll have the conference pick somebody else.
We'll discuss all of that and the next balance of power political drama with Julie Norman. I mean, Danny, it was a toxic combination for bonds, but there is literally a wildfire cascading across global bond markets. We had the worst day of 2023. There was a propulsion in the bond market yesterday that I haven't seen for a long time. The JOLTS number, can you really put this entire global bond right down to a JOLTS number coming in higher than the Fed had wanted to see at 9.61 million? We have political chassis. It's an Irish word. Crisis is the global word. Chassis in Capitol Hill as McCarthy is out. That should provide, in theory, a bid to Treasuries, but we're getting closer to the shutdown. 10-year government bond yields in Germany, the highest since 2011. Aussie rates are playing the catch-up with yesterday's session in the United States of America, but they are continuing higher this morning. State Street, I love their swag. When all the world is fearful, they say the Fed will dramatically cut next year by 100 to 200 basis points. I want to give you a vision of the sound of intervention. Let's have a look at dollar yen. This is the moment. We traded up at 150.16 yesterday, and the Bank of Japan, or the Ministry of Finance, I should say, said we have had enough. Down it went. And here's the risk. The Ministry of Finance has not confirmed or denied that they did intervene. And I like what Jane Foley had to say over at Rabobank, which is you might slow the momentum, but they're going to be darn disappointed. We're back at 149. If you intervene in size and scale unilaterally, it might slow the pace for a period, but it will not define the winner of the race. Danny, good morning.
Good morning, Menace. Something certainly feels like it's changed. I think you're absolutely right. Is one JOLTS number enough to do all of this, enough to have that bond picture you just laid out? Equities, they are feeling it. U.S. futures continue to fall. They're now at the lowest level in 4 months after the cash equity trade yesterday ended down 1 1/3%. VIX index, that goes back above 20 for its highest level in 4 months. The curve, it is inverted. In other words, the spot price is higher than contracts that are further out. A clear sign of stress in this market. Somehow, amid all of that, Menace, European equities are higher. Go figure, but just by not even 0.1%. But if stocks are selling off, yields are higher, dollar is higher, the risk picture looks like this, Menace. The risk for the Fed is unduly tight financial conditions. The Goldman Sachs Financial FCON Index is now at its most tight level since we had that hawkish wave in 2022. I'll show you that chart in just a moment. But, Menace, the question is, what breaks? Is it bond yields that stop their march higher, you can see here, or is it the economy? Is this threatening the American economy unless we get yields under control, Menace?
Well, it's certainly going to be music to the Fed's ears. The bond market is doing what they can't do. You noted the stoicism of the credit markets. Well, that sort of broke ever so slightly. You're looking at credit market buckling yesterday. Danny, you're looking at some of the highest levels since 2009. And the cost of, I suppose, protecting against junk bonds, well, those spreads are blowing out a little bit, and the CDSs on junk are also becoming more expensive. Danny's never far from an FCON chart. Let's take the conversation to Katrina Dudley. She's the investment strategist at Franklin Templeton Investments. Good to see you. I mean, we've tried to contextualize risk, okay? I think these moves in the bond market are pretty staggering. You're a lot more stoic. You say, nah, calm down. This is just a readjustment.
I think it comes from being a long-term investor. This need to taking a step back and really ignoring some of this short-term noise and looking at the long-term outlook. We're looking at the short-term rates versus the long-term rates. And yes, the market is pricing in 2 to 3 rate cuts next year. But from our perspective, yes, the JOLTS number did come in at 9.6 million. There are these job openings that are unfilled. So the economic data is telling you that companies are still looking to hire. And that is the real engine of the economy here in the United States. It is a consumer-based economy, and the consumer is okay.
Katrina, couldn't I, though, also look at the long-term picture and say equities, despite selling off, are still expensive and yields are moving higher? Those two things can't be true at the same time.
When you look at the equity valuations, I think you've kind of got the magic 7, which have been a big driver of valuations. And I think that we're looking at the dichotomy in the market, and that's what's opening up opportunities. Where we're seeing a lot of really good opportunities is in the small and the mid-cap space. And those are not those magic 7, as we call them. These are the names that are very much economically sensitive. And we think that if the economy continues to just kind of move along, we are not in the camp that we will have a great recession in 2024. We're actually probably in the camp today that we may not have a recession. And that's something that's been a slight change in our outlook over the last couple of months in moving from this fact is that we think that the market can muddle through.
Muddling through, but you also talk about, in the equity perspective, you say, look, defensive, look poised for a snapback. You talk about, and I want to get some sort of context around this, you talk about recession or even a more minor catalyst could flip the equity leadership script. Given the dislocation in bonds or repricing, whatever way you want to describe it, I would say we're in a dislocated moment. You say we're just repricing. Can that flip this script? Can we reach a point of where there's a self-propelling philosophy in the bond market and we see a more rapid unwinding in the bond market, and that could tip your equity market?
I have a feeling that people haven't actually woken up to the fact that for the first time in over 20 years, the yield on the bond market is actually higher than the yield on the equity market. And I think that that is the first premise that we need to really start making people aware of, is that there is yield now in the long-term and the short-term bond market. As we flip that script and we look at the equities, yes, you've seen sectors like utilities sell off significantly. They were the bond proxies of the equity market, and therefore I think a lot of that downturn has been priced into these markets. But as we look and as we think of going forward, I think that where you're going to find opportunities is going into areas of the market that will benefit from the economy just being stable.
Katrina, then, if the economy isn't just stable, just lay out that scenario for me where the landing looks something more like a hard landing. How do you need to adjust in that case?
I think if we do see a hard landing, we've got to first put it into the context of why we're going to have a hard landing. And I think the first thing is we do need to see that inflation number break significantly to the downside. We believe that it will have a 2 handle by the end of this year. We've been in that camp for a long period of time. But we flip and we say, what else is going to go wrong? Well, I first need corporates to stop hiring. And we really haven't seen any signs of that. The second thing is I need that IRA and the CHIPS Act and the investment that we're seeing to stop. And those are longer-term investments. So even if companies want to stop, you're going to continue to see that tailwind because these are long-term investments. So I need a number of things that are already in place to suddenly reverse for you to have a very deep recession, which is why we have confidence that we're not going to have that deep recession. So it's really just us putting together the pieces. And it's also going back to the fact that we're an active equity manager. We speak to companies on the ground, and I speak to a lot of industrial CEOs, and they are all keeping their labor. And not only are they keeping their labor, they're indicating to the market that they want more labor, and that's what that JOLTS number is.
The other big topic is Japan. I talked about intervention watch from the Ministry of Finance. Again, the velocity in dollar yen is testing the Ministry of Finance nerves. But from an equity perspective, a weaker yen, Japan labor costs are materially lower to a lot of other places in the world. How are the tailwinds for you in Japan?
If I take a look at Japan as a market, I do not think that as a market is very, I know that everyone focuses on the currency. We're actually looking for an appreciation of the yen, and that will relate to the fact that we see a narrowing of those interest rate differentials. But then let's take a look at what's happening in the underlying Japanese market, because there is so much that's in their control. And that is what makes us very bullish. We have pricing power, so we have revenue growth. We have productivity, which will drive margins higher. We have a shift in the culture in Japan to an equity culture, and we have things like the TSE, which is encouraging dialogue with investors.
Right.
So we are very optimistic on the Japanese market, and we don't think it's an optimism that is dependent on the yen and what happens in that market. We think it is internally driven, and if you can find great domestic companies, you actually even take that yen out of the equation.
Katrina, we got to fit this in before we let you go. Kevin McCarthy is gone. It's a divided Republican Party. It's a divided House, 40 days away from a shutdown. Moody's has warned about the creditworthiness given governance issue. How does that factor in to your American equity outlook?
I have just continued to watch the U.S. government get to the brink and come back. So I do fundamentally believe that our politicians want the best for our country collectively, and so they will go into these shutdown negotiations with a positional stance. But what we see is when, like, the rubber hits the road, and you're talking about cutting the paychecks to our veterans, you're talking about the military not getting their paychecks, that they really are good people at heart, and I think that they will work together. But I do think you have got a period of uncertainty as you have positional negotiation going into that shutdown, but we do not believe that we will have a shutdown.
Katrina, your phone's going to go pop, pop, pop. You just called politicians people of good heart. That's the most generous. That's the most generous description to the average politician that I've heard on a global stage. Thank you very much. That is Katrina Dudley from Franklin Templeton, holding her nerve, investing for the long term. Here's some other stories that we are watching. They're trending on the terminal this morning. You got Izzy Englander's Millennium is said to be in talks to invest billions of dollars with the rival hedge fund Schonfeld as part of a partnership deal. Now, the investors have been flocking to multi-strategy hedge fund firms like Millennium, Citadel and Schonfeld in recent years, and it's in the hopes that I suppose the pods of traders will help churn out consistent returns. There's a word in an increasingly volatile market. Danny, good morning.
Good morning. Well, elsewhere in hedge fund world, Ray Dalio says Washington's restrictions on advanced semiconductor exports to China are similar to the petroleum ban it imposed against Japan prior to the outbreak of war in 1941. Dalio spoke to Bloomberg's David Western at a conversation at the Greenwich Economic Forum.
The reason in World War II, war with Japan, you had the cutting off of the oil and then the sanctioning them taking their payments. So you have a somewhat similar situation. Chips is like oil back then, and it's a very, very, very delicate issue.
And we have a thinner and a less hairy Sam Bankman-Fried showing up at the first day of his trial in Manhattan. There you go. That's the kind of depth that the world looks for. How you look in court. Coming up, we're going to speak to Julie Norman, co-director for the Centre of US Politics at the University College London. What is next after McCarthy ousted as a Speaker of the House? Plus, we speak to Philipp Freise at KKR about the state of private equity right here on Bloomberg.
I don't regret standing up for choosing governance over grievance. It is my responsibility. It is my job. I do not regret negotiating. Our government is designed to find compromise. I don't regret my efforts to build coalitions and find solutions. I was raised to solve problems, not create them.
That was the former House Speaker, Kevin McCarthy, there speaking to reporters after being ousted in a revolt for the first time ever. Now, the U.S. House Speaker has lost a no-confidence vote. Joining us now is Kate Ackley from Bloomberg Government. Kate, I mean, the theatre was impressive. I was tuned into the networks yesterday, the roll call of votes. McCarthy is out, not restanding, we understand. What happens now?
Yes, it's great to be with you today. It was an extremely dramatic day yesterday on Capitol Hill, really nothing we'd ever seen before. So now what happens next? Over the next week, there's basically a mostly behind the scenes campaign going on among other House Republicans who are looking to become the next speaker or who are pushing for, you know, their allies to be speaker. And we have kind of a short list of people who are the contenders, the most likely people who could take that spot, fill Kevin McCarthy's shoes. Not surprisingly, some of the names that are emerging are people who are already in House Republican leadership, starting with McCarthy's number 2 person, Steve Scalise. You know, he would be probably the most obvious choice. He's been undergoing treatment for cancer, so that has led to some questions. Is he up for this job, which is obviously a grueling, very demanding job? It requires a lot of travel, meeting with party donors, things like that. He has said he feels well, that he has, you know, it would be up to the job. And, you know, the word was last night that he was making phone calls to potential supporters and, you know, sort of drumming up support like that. But he's not the only one. The number 3 person in House leadership, Tom Emmer, he's the whip.
Yeah.
He also could be a contender as well. And there are others.
Kate, I mean, you mentioned drumming up support. What about McCarthy? He's no longer Speaker of the House, but the man still needs to fundraise. What does this mean for him in that regard?
Well, Kevin McCarthy has been just a huge fundraiser for the party, for other candidates. He's transferred and helped raise millions of dollars for House Republicans and their candidates. You know, he's helped raise money through outside groups that are aligned with House Republicans. So this is going to be at least an immediate hit. Who can step into his shoes in terms of the fundraising? And what will he do with the money that he has left over? He has, you know, over $14 million that are, you know, in his own personal campaign and in his leadership PAC, which is another fund that, you know, he can use to try to win friends and influence people. So we'll be watching what does he do with the money he's sitting on? What does it mean for the party's fundraising going into the 2024 elections? I think there's a lot of skepticism among some donors to the party. You know, this is a lot of uncertainty. There's a lot of confusion about what the House is going to be able to do. You know, you're talking about funding the government after November 17th. So I think there's going to be a lot. Whoever takes over this job next is going to have to reassure the party's donors, as well as the people on Capitol Hill.
Well, let's see. We're inching ever more towards this this vote again on government funding with this leadership contest. So the markets are doubly spooked, aren't they? Kate, thank you very much. Kate Ackley there. Bloomberg Government with the very latest on the exit of McCarthy. Danny, we just got to check in on these bond markets. We really can't do them enough because it's now like a wind fire across the global bond markets. As you see, German yields, they made it above 3% for the first time since 2011. There's a major, Stephen Major note going out saying, look, we're starting to see disruption across other fixed income markets because of higher US bond yields. We are incrementally moving towards 5% in 10s. This is Bloomberg. This is Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger at London HQ. So Ford says it made a new comprehensive offer to 57,000 employees as the UAW strike heads towards its fourth week. This is the seventh offer. It includes a pay raise of more than 20% with less time for new workers to reach that top wage tier. Sources told Bloomberg a little bit earlier that UAW wanted at least 30% of a wage increase and a restoration of traditional pensions. Danny.
Meanwhile, Intel announced a spinoff for its programmable chip unit. Altera will become a standalone business from January 1st through either an IPO or new investment, part of a plan to raise funds for a costly turnaround effort. Intel paid $14 billion for Altera in 2015, Manus.
Now, here's one to pay attention to. Barclays. Barclays strategists have produced a report detailing drugs used for weight loss, like Ozempic, pose a real risk to companies ranging from fast food, restaurants, cigarette makers, and credit market prices aren't fully reflecting the downside. There you go, Danny. Who would have thought? GLP-1 agonists. I didn't know that that's actually what these inhibitors were called. But this is Barclays' big recommendation. Short fast food credit, Danny.
Yeah, I'll tell you, Citrini Research, who was on Odd Lots, the founder, has been way out in front of this. Their trade, Manus, get this, short insulin pumps, short CPAP machines, and short gyms. Ozempic putting businesses out of business left and right, it seems.
Well, I can just tell you, adding to the move to New York, I mean, we'll get to the broker for the apartment next week. But, you know, already splashing out on the gym, it's just multiple costs. But here's the price differential for you. Ozempic in Dubai is 50% cheaper than it is here in the United States of America. Not that I bought any.
Huh, no.
Welcome back to Bloomberg Brief. I'm Manus Cranny in New York.
And I'm Danny Berger in London. Here's what you need to know. A sell-off in global bonds gathers pace. Treasuries bulldoze their way through world markets to the greatest extent since the pandemic hit in 2020. Testing the BOJ, the yen retreats as officials refuse to say whether they intervene to bring stability in the FX market. And D.C. drama adds to the turmoil. Kevin McCarthy becomes the first ever U.S. House Speaker to be removed from his post, increasing the odds of a U.S. government shutdown. We're going to be discussing what's next for the balance of power with political expert Julie Norman. Those bond yields, though, that is the dominant story for this market, for this equity market. Is it at a point yet where you need to be worried, where you can't be buying risk because the yield you're getting from the bond market is just too juicy? U.S. futures decline yet again. Yesterday, the cash market fell 1 1/3%. We're down at the lowest in 4 months. VIX, that pops back up above 20. The curve is now inverted for the first time since the bank drama happened in March. This essentially means we're more fearful about this very moment than out in the future. It is a sign of stress. European equities, though, they are moving kind of higher, Manus. Maybe this is a reflection of a slight bit more of calm in at least the European bond market right now.
Yeah, I think give it another couple of hours and maybe that fear factor will come in again. Look, there is a wildfire ripping across global bond markets. The invective was the JOLTS number yesterday, early in the day at 10 a.m. in New York, and that 9.61 million set off a wildfire across the bond markets. 10-year paper are doing their best to get to 5%. I've just had an IB chat with an asset manager in Dubai saying, why are you saying this is some kind of a paradigm shift in bonds? This is just normalization of where we are to a higher rate environment. German rates went to 3% this morning, the highest since 2011. It was the worst day for US bond markets so far this year. The propulsion that you saw drive higher. Aussie rates have put them there because, A, they're playing the catch-up game from yesterday, but you will have got this propulsion now. HSBC have just put a note out saying what's happening here is really beginning to dislocate across the assets. And then you've got State Street saying, no, don't worry, you're going to get 100 to 200 basis points of cuts next year. And that's why they want to lump up and look large in duration. Now, the oxymoron is I want you to hear and see the size of intervention that in theory possibly happened yesterday. Dollar yen, 150.16 is where she traded, and the theory is the Bank of Japan came in and took us off those lows in yen, highs in dollar. But this is the issue. They have not confirmed whether they were in the market or not. And as Jane Foley says, yeah, they came in and they kept a lid on dollar yen, but they're going to be pretty darn disappointed. We're back at 149. And of course, we saw the first intervention since the 1990s last year. This is unilateral intervention. Unilateral intervention in of itself perhaps cannot stop the trajectory of dollar yen. You may need something else. Danny, good morning.
Good morning, Manus. And I go back to what Kit Jukes said to us earlier this week. You can't have your cake and eat it, too. You can't be defending the band of yields, keeping monetary policy easy, and at the same time trying to lessen the weakening of the yen. You can't do both of them.
No, and you've got to grapple with a whole host of other issues. You've got FCON tightening, you've got credit spreads popping higher, and the cost of insuring junk bonds is also rising. But politics, Danny, politics is the new malevolent force. 40 days of angst in the political desert of Capitol Hill. Danny.
Yeah, it was a historic vote, Manus. U.S. House Speaker Kevin McCarthy was ousted by a small group of radical members of his own party, led by Representative Matt Gaetz of Florida.
It seems very personal with Matt. It doesn't look like he's looking out for the country or the institution. If you throw a speaker out that has 99% of their conference, that kept government open, and paid the troops, I think we're in a really bad place for how we're going to run Congress.
You have paralyzed the House of Representatives today. To whose benefit? People have called you a narcissist. People say that it's to your benefit alone. Is it to the benefit of you and to Donald Trump?
It's the benefit of this country that we have a better Speaker of the House than Kevin McCarthy. Kevin McCarthy couldn't keep his word.
Joining Manus and me today is Julie Norman, co-director for the UCL Center on U.S. Politics. Julie, the Democrats didn't come to Kevin McCarthy's rescue. You write, Democrats miss an opportunity to go high and push back on this brand of politics. Julie, what should the Democrats have done in this circumstance?
Well, look, Democrats certainly had no love for McCarthy after the last 9 months, and especially with McCarthy putting forth the impeachment investigation and going back on some of his promises regarding the budget and other kinds of agreements that had made. I can definitely see why Democrats were not feeling the love to bail him out. But with that said, this kind of maneuver that we saw from Gaetz really is just a new kind of politics. It's not only bad for the GOP and for the Republican Party, but it's bad for Congress and the institution. And I do think for Democrats, they had an opportunity, if they wanted to take it, to go high on this one, to push back at Gaetz more than McCarthy and say, look, we're not happy with some things McCarthy has done, but this kind of antics that we're seeing from Gaetz isn't something we want to reward or see repeated. And at the end of the day, McCarthy did come through with some very important bipartisan agreements, avoiding a fiscal cliff, avoiding the shutdown. And that's something that I think some Democrats, might regret having someone in that position who wouldn't make those decisions in the future.
I mean, if the Democrats, Julie, good morning from New York, if the Democrats had got in behind McCarthy, the accusation would be that they're supporting a Republican agenda with various components in it that do not sit well with many factions in the Democrats. It wouldn't have played. Do you think it would have played better for them going into the general election that they kept government open and running, as it were, rather than doing nothing?
Well, I mean, a year from now with the elections, I think we'll see how much this stays in the memory of many voters. But you're right that there was been a political risk in backing McCarthy. At the same time, though, there are numerous things on Democrats' agenda that do matter to voters. People don't want a shutdown. They want the budget to be settled for next year. Investors and those watching Bloomberg don't want unstable markets. And for many other Democrats, they want to see aid to Ukraine. They want to see other priorities moving forward. And none of that can happen when the House is thrown into this kind of disarray and all the focus for the upcoming weeks has to very necessarily be on the speakership.
So tell me then, Julie, in 40 days from now, how likely is another government shutdown?
Unfortunately, with what happened yesterday, a shutdown is more likely than less. We knew already it was going to be a bit of a struggle to get to some kind of agreement, even with someone like McCarthy, who was willing to maybe make some concessions, willing to maybe make some deals. I don't think that there's going to be a speaker in that position next who is either willing or able to do that. Remember, McCarthy was operating under very strict constraints from his own party. I don't see them letting up on that with whoever is in that new position. So I can expect in November we'd see something very similar to what we already have seen, but perhaps with a little bit less leverage for those who are willing to look for a deal and take a more moderate approach on this.
So we're showing some of the faces of the names who will run for this role. Steve Scalise, as we understand it, has health issues. You've got Emma there, McHenry and Cole. Which of these has perhaps the best potential to deliver a government that remains open and no shutdown? A very fast first take.
Yeah, I mean, I think it's too early to say who will actually get the position. I think Steve Scalise is probably the best positioned right now to carry on the kind of leadership that we saw from McCarthy. He was the number 2. He was pretty loyal to McCarthy throughout, even up through these last several days. So I think that's where a lot of the focus will be. But as you said, there are others whose names are certainly being floated as well. And we'll just have to see as the votes go. Obviously, it was not easy for McCarthy the first time around, 15 rounds, and it probably won't be very easy for any other individual either.
Meanwhile, Julie, the market is in meltdown mode. Some of it is not tied to this, but some of it is tied to a ballooning government deficit, at least on the long end of the curve. Goldman Sachs is out with a research note saying that servicing costs for debt will reach 4% of GDP by 2030, given to how yields have moved. Julie, what is the reality for this next government when it comes to the American fiscal position?
Yeah, well, I think the reality is that there needs to be some cooler heads in the room who can actually look at the more mid and long-term implications of what's happening now economically and financially. And what we're seeing instead is both parties playing this very short-term political gamemanship that is maybe politically shrewd for electoral purposes, but really aren't moving us forward on the big questions that we need to be thinking about in terms of the U.S. economy for the long term.
Julie, the risk is this. There is a political vacuum on the Republican side. The issues have not gone away. Ukraine, border control, and fiscal largesse. We still have these 3 issues. Whoever takes over, do you not think that the GOP are going to push harder and harder on the new speaker on these 3 very core issues? Are we moving so far away now from any possibility of coalition politics?
Yeah, I think we've been moving away, and I think the new speaker will throw that into even more of a kind of polarized situation, but even more so just 2024 and the election year. We know that issues that have been simmering for a while, like a growing antagonism to Ukraine aid, those have not really been at the forefront that much yet, but I think they will become increasingly wedge issues in 2024. Obviously, the border, an ongoing issue that I think many in both parties are keen to address and see some movement on. But again, in an election year, it's harder than ever usually to get that kind of bipartisan cooperation. And whatever restrictions this new speaker is under will make that just that much more difficult.
Julie, really wonderful to get your thoughts this morning. Julie Norman there of UCL. Now, coming up, we're going to be speaking to Philipp Freise of KKR about the state of private equity as bond yields and borrowing costs march higher. This is Bloomberg.
This is Bloomberg Brief. I'm Manus Cranny in New York. Danny Berger at London HQ. There's only one story, Danny. It's the bond markets. We are in the mood to kiss 5% on these bond yields, will we? It's about real yield back in the market. 30-year government bonds, the biggest bond, the worst day for global bonds that we've seen in 2023 yesterday. Some of the moves were really quite stupendous. HSBC have a note out saying these moves in the bond markets are starting to cause worry across all assets. We have a buyer's strike at the moment in the bond market. Japanese government bonds, they're going to test the mettle of the Bank of Japan. And Germany, of course, made it to the highest level since 2011, Danny. Not only did we kiss 3%, but we traded at 3%. Good morning from New York.
Good morning from London, Manus. And this idea that it affects all assets, the question needs to be asked, does it also impact private capital? Because it's clear what's happening in public markets. Joining us now for an exclusive conversation about the environment for deal making and private equity is Philipp Freise, KKR co-head of European private equity. Philipp, I feel like you always join us on a drama-filled day, so it only feels right you're here when bond yields are touching new highs. You have a public market that's come to terms with this higher for longer narrative. Has private equity come to terms with it?
Well, Danny, good morning. Thank you for having me on. And I would first say that we wouldn't consider it as drama at KKR. I think you had my partner Henry McVeigh on multiple times. We see it as a normalization that was to be expected after 15 years of extraordinary monetary and fiscal support that is now being withdrawn. We are expecting inflation to remain longer, higher for longer. And as a result of that, as a firm, the way we invest in private equity is very razor-focused on the new environment, which means you got to go to people and offer them more than just capital. In this turbulent environment, they actually want a partner who helps them navigate that environment, whether that's with operational support, whether that is through the global platform that we have, or whether that is through KCM, our capital markets business, which helps them actually navigate those turbulent debt markets.
So that's what changes on the deal origination side. What about the debt side and getting financing side? What changes there with higher for longer?
So I would start to say you saw in September the European leveraged loan market was actually quite constructive. I think 8 billion euros compared to 9 billion in June is a healthy level. The European leveraged loan index closed at 96, a little over 96, so it's up for the months. So we actually see a bit of a thawing in that market. It isn't as difficult as it was at the end of last year. So at the end of last year, 22, if you wanted to do a deal, as by the way we did with April in France, you almost certainly would have relied on a club of private lenders. And that would have been done in the kind of 600 to 650 basis points over territory. You now have a term loan B market in the leveraged loan market, which is in the 400 to 450 handle. So while interest rates are rising, you pointed that out, spreads are still compressing relative to the very distressed levels end of last year, which is constructive for private equity.
So constructive environment. Good morning, Philipp. Good to see you. Tell me this, in terms of the competitive landscape, the market is opening. The world that I've just come from is Saudi Arabia, the UAE, with the likes of Mubadala, with the likes of the PIF, etc. To what extent are they a direct competition to you now? Are they heating this market up in terms of going after the same deals as you?
This is a very important region for our industry. They are close partners to us. They have been for many years. We have a constructive dialogue with them on some of the things we are focused on. As we discussed with Danny, what we believe in to navigate this environment, you got to be thematic investors. On the one hand, we believe, for instance, digitization has not run its course in Europe. An aging, demographic opens many opportunities in healthcare. And then, of course, we have that massive energy transition, which creates opportunities. This region wants us to partner with them to tap those opportunities. Therefore, to answer your question, we see them as partners, not as competition.
Now, there certainly has been a lot of stress among portfolios, given, the cost of capital is moving higher. I know you had to hand back the keys for two companies, Envision and UNSA. What went wrong? Is that related to the higher cost of debt?
So I would say generally, if you think about our portfolio holistically, it's performing robustly. We are razor-focused on risk management and portfolio construction. It's part of our job to make sure that in a portfolio of 20 companies, the majority performs strongly. I think this year we're expecting both double-digit growth on the revenue and on the bottom line. And then, of course, you always have certain circumstances that are tougher that we work through, hand in hand with our bank partners.
Well, part of the reason I think of it, Bank of America, I believe it is, had this note out saying 2024 private credit defaults would be 5%. I mean, that's pretty low, but it's higher than it has been. Obviously, a lot of private credit is going to be borrowed by companies like your portfolio companies. Does that level sound right to you?
So, I would speak for KKR, right? In terms of the industry, there had been certainly circumstances in the boom of 2021 where there was too much leverage used. We have used on average 4 times across our portfolio. In fact, if you look at the two most recent deals we have done, OHB, the German space deal, and FGS Global, which is a global communications agency, we have actually financed those deals without any leverage. So, between 2009 and 2020, the average interest rate was 0.7%. Definitely, we are in a different environment now. I don't think we'll see default levels creep up to a dangerous level, but we certainly will see them creep up.
So tell me this then, we're grappling with what higher rates means. The bond market is, the equity market is, private markets as well as debt. When you look at the two big IPOs that Danny and I have covered recently, which is Arm, obviously listing here, and Instacart, both are back below their IPO levels. How would you describe that exit environment at the moment? These were very Arivest moments on the IPO calendar. Should we be excited? Is the landscape really opening up?
I mean, look, it's normal human behavior that after a long period of distress, crisis, turbulence, that people really hope that the next boom is just around the corner. Unfortunately, the next boom is not just around the corner. This is going to stay tougher much longer. Great companies will have space to go public, but you will not see what we saw before, a large series of IPOs with companies of average quality. We see at KKR the environment to be tougher longer, which, again, I would say, which is really interesting. We have not seen, and I've done this for 22 years now, as much interest in public company CEOs, in entrepreneurs and families to take their companies private today than we've ever seen. Because people realize that having the public markets as your partner is not as helpful as a private equity partner who can help you to navigate this space.
That sounds like a permanent change, though. That sounds like more than just higher rates. Is that a permanent change, just from here on out, less IPOs?
I don't think it's a permanent change. I think what capital markets really hate is uncertainty. It's not a bond route we are seeing now. It's just a normalization. I mean, Jamie Dimon talks about the fact he believes that rates will have to go to 7% before the market normalizes. Others expect it to be a little higher than 5.5%. Who knows? So the market is trying to find its footing in terms of knowing what the outlook is. The moment we are through this and know a little bit more where the outlook is, things will stabilize and the window will open more sustainably.
Right. I mean, Birkenstock's going to IPO. Manus and I have been debating about whether you'd buy Dior Birkenstocks. Would you, Philipp? Would you spend $1,000 on Dior Birkenstocks?
I'm Kenaf.
They're a German company, though. You got to represent, I guess, Dior not so. Philipp, really wonderful to have you on. Thanks so much. That's Philipp Freise, KKR co-head of European Private Equity. This is Bloomberg. This is Bloomberg Brief. I'm Danny Berger in London alongside Manus Cranny in New York. Let's get you set up for your trading day now and take a look at what is ahead. We're going to get U.S. PMI data coming out at 10 a.m. Eastern. We're going to have more Fed speak from Fed Governor Michelle Bowman and Fed President of Chicago, Austin Goolsbee. Then in the next hour, UK Prime Minister Rishi Sunak is taking the stage at the Conservative Party's annual conference in what would be the biggest speech of his political career, tax implications under pressure. Now, the fraud trial for FTX co-founder Sam Bankman-Fried continues as opening arguments start today. The 31-year-old pleaded not guilty to 7 counts of fraud and conspiracy. And Manus has our BN team laid out. He's thinner and less hairy. I'm going to be honest, I don't know what to make of that.
Well, it's all about presentation in the courtroom, isn't it? But how do you present? How do you get equity investors to hold the faith? We've got this fairly vertical move in rates. I thought I'd bring this to you. This is about the premium that you've got left in equities relative to bonds. There's only 33 basis points of earnings premium in the SPOOs compared to the surge in 10-year yields.
And at the same time, we're just talking to Julie Norman. Bond proxies like utilities under pressure with that higher yield in treasury markets. She still likes equities. Find valuation, Manus, beyond the big cap tech into small caps and things that make sense. Good morning from London.